On today's episode, I am going to put two crazy growth stocks against each other and see which one would be a better investment for me. So, the first company is one that pretty much everyone has heard of, and that's going to be Amazon. The behemoth themselves has made an appearance to my Monday matches. And the second one is C Limited. This is another e-commerce business and it is very strong in growth in Southeast Asia. I actually just did an episode on them last week where I did a full in-depth analysis on them. So if you guys want to learn more about them after this episode, make sure to check it out. So if you are new to this channel, this might be the first time you see Monday matches. And like I said, I put two companies against each other and see which one I prefer to invest in. And here you might go like, Jose, why would I watch this if you're pretty much just going to give points to the business you like the most? And I've actually created a point system where I'm pretty much going to be taking a look at actual numbers from market cap growth, revenue breakdown, future growth, revenue growth, margins growth, the balance sheet, cash flow margins, valuation based on forward PE ratio and forward price to sales ratio. Out of all these points, there's only going to be one based on my thoughts. And just because one, and let me just say this before, I don't know who the winner is going to be of this one. I just pulled up the data, but I haven't obviously done the show yet. And at the end, it's always a surprise for me. But I do believe if Amazon is the loser, I'm going to get a lot of hate here. But I just want to say, just because one of them does not win does not mean that it's a bad investment for me, right? This is not the whole point. Right here, I just pretty much just want to show two crazy growth companies. And if there was only one to invest in, which would I invest in? But at the same time, both of them can actually be great stocks. And I do believe both Amazon and SE are very strong businesses and ones that I would thoroughly enjoy investing in. So let's get started. And if you are new to my channel, if you are a long-term investor, if you like learning about growth stocks, and if you like learning fundamental analysis, make sure to hit the subscribe button, the thumbs up, and the bell. It helps the small channel out so much, and I truly, truly appreciate it. For all my previous viewers, thank you guys for the support and thank you for coming back. Like always, hit that thumbs up. And if you guys ever want to get in contact with me, I'm very active on the YouTube comments, so feel free to post there. But I also have a Twitter and a Discord channel, which is free to everybody. Make sure to follow me there. The Discord channel, like I said, I have plenty of great investors in there, just communicating, sharing ideas. But remember, this is not, I am not a professional. All of this is free. And these are just my opinions and should not be taken as advice. Finally, one I don't have here, I do have a website, which is called josenaharo.com. I am doing a weekly newsletter and also starting to write written content for those that want to follow different style of reading about the stock market. And before we begin, actually, let me know, I want to see who my viewers are. Do you guys believe that Amazon's going to win today? Or do you guys believe that C Limited is going to win? So let me know on the comments below. All right, so the first point we're going to take a look at is market cap growth. And here, market cap growth, we want to see in the past 5 years, which one has returned better returns to investors. After that, we're going to take a look at the revenue breakdown. And in the revenue breakdown, we want to see how that revenue is coming in and kind of understand what that business does. Again, this is not going to be a full analysis on them. So if you guys want to learn more about C or Amazon, I definitely recommend checking out my other videos. Just search in my history. I'm pretty sure I've done a video on both of them before. So let's start off with market cap growth. All right, so first let's start off with Amazon. And Amazon, if we take a look at the 5-year chart, has returned about 542% to investors. This is a business right now sitting at a $1.5 trillion market cap. So that's actually pretty insane, right? It's grown 5 times. So just 5 years ago, this was still sitting at about, what is 5 divided 115? About $300 million market cap, a $300 billion market cap. So that's a great example of showing a lot of people right now say, hey, these big tech companies can't grow anymore. But 5 years ago, this was a $300 billion market cap. And probably those same people said that about Amazon 5 years ago, and look at it, it just continues to grow and grow. So 540, what was it, 549% return, 542. So now let's take a look at C. So this one's a little less known. So for those in my podcast, the ticker is SE. And like I mentioned, I did do a video on this one earlier last week if you guys want to check it out. So if we take a look at their returns, it's actually pretty close to Amazon, but this is a bit higher. This is 599% in the past 5 years. So it does beat Amazon in returns to overall shareholders. But remember, both of these have done over 500%. So over 6 times you have gotten 6 times your money, which I think is ridiculous. In less than 5 years, both of these have beaten the overall stock market. If we want to take a quick look, I already know because I've done these videos before, but SPY in the past 5 years, I think has returned about 45%, close to that value. So both of them have beaten the market by over 10%, 10 times as much. So to me, that is insane. And both of them have been great investors, have been great returns to investors. So congratulations to anybody that has been holding for that time. And you might be like, Jose, that's 5 years ago. Who the heck would hold a stock for that long? And those are the people that are probably not making that money, right? You can see by holding 5-10 years, that's where the true money comes in. So yes, there are probably a lot of people that have been holding since 2015, and those are the people with a lot of money. And that's the patience I'm trying to try to achieve for here in my investment. I am a growth style investor, and I want to be able to hold these companies for 4, 5, 6, 7 years. As long as the overall business does not change from my due diligence, from why I invested in that company, I am going to continue to hold. All right, so the first point went to C Limited on that market cap growth. The second we're going to take a look at is revenue breakdown. And like I mentioned here in revenue breakdown, I want to see where does this company's revenue come from. Because one thing, right, when investing in a company, I do feel safer if they have multiple streams of revenue, just like in anything, just like in your personal life. If you have multiple sources of income coming in, if you lose one of those sources, it's not something that would really truly hurt the business, right? It would hurt, but it wouldn't really destroy you. So that's what I'm trying to look here in revenue breakdown. I want to see where that revenue is coming from. And are they a one pony show, or do they have a full stable of horses? And I don't know why I ended up using that saying. I don't even know anything about horses, but I'm going to keep it here. All right, so first let's take a look at Amazon. And Amazon, I'm going to explain a little bit less. I do think I'm going to go a little bit more in depth in C, just because more people are aware of Amazon compared to C. But Amazon makes revenue 3 ways. The first is what they call North America sales, and this is all the sales that they do here in the in North America. The second is internationals, and we can see this chart right here. 61% of the total revenue from Amazon comes from North America sales. The next is 26% comes from international sales, and this is everything, right? Amazon, as we all know, they are a giant. They own a lot of different companies, from Ring, from Audible to Kindle to all this. So all those, they can't really distribute that into small packages, because then they would have just a huge list. But we know for a fact that Amazon has a huge list of products that help with this revenue growth, opposed to their e-commerce sales as well. Then the smallest of them is 13% in AWS, which is their clouding system, and I am a big bull in the clouding market. And this is probably one of my favorite reasons to invest in Amazon. So Amazon, it is the #1 leader in the clouding market right now, beating Microsoft. We can take a look at that, and this is that I'm a huge Microsoft bull. And AWS, right, we can see here from this chart from Q4 of 2019, Amazon right now has about 33% of the worldwide market in the clouding business, and this to me is one of the biggest reasons to be a bull in Amazon. Microsoft is second in line in 18%, so almost half of what Amazon has is the second in place. Then we have Google Cloud, IBM, and Alibaba, Salesforce, Oracle, and Tencent for those that want to know that list. And if you guys actually want me to do a clouding top 5 clouding companies, actually let me know, and let me know in the comments, and I can probably take a look at all these and see which one I like better. So now that we know where Amazon's revenue comes from, and just one thing, the main reason I am very bullish, and this is going to be off topic, the main reason I'm very bullish in Amazon for AWS is even though AWS is only 13% of this business total revenue, this is the part of the business that actually makes money. In North America, which is 61% of their total revenue in trailing 12 months, they've only make $1.3 billion out of it. International actually loses money. So remember, North America makes 1.3 billion. International actually loses money, and AWS, which is only 13% of total revenue, actually makes $3 billion of revenue. And this is more than double of what North America does, and that's that AWS is only 13% where North America is 61% of the revenue. But now we know that they make up revenue from those 3 sectors, and within those sectors is broken up into a lot of different products. Now let's take a look at C. So first, let me just explain what C is. So C is this big e-commerce market in Southeast Asia, and I'm pretty sure that's where the name C comes from, Southeast Asia. If not, then I might seem like a dummy. But here they have 3 main products. The first one is Shopee, and this is an e-commerce store very similar to Amazon. The second is C Money, and this is like a peer-to-peer electronic financial service. So it's like a PayPal, like a Venmo, where you can do peer-to-peer lending, e-wallet, and easy transactions like that. And the third one is Garena, and this is their digital entertainment. Here they mainly have a lot of esports. They have a lot of big names under their platform, where it's more like a social esports Facebook, I want to say, and where you can do a lot from gameplay and all types of digital entertainments there. So they are actually in 3 markets that I am very bullish on. They're in the esports, gaming, they are on the e-commerce, and they are on the e-payment as well. So both of these are in great markets, where Amazon is mainly in the e-commerce and the clouding market. So now we took a look at the revenue for Amazon. Let's take a look at the revenue from C. So C actually also has pretty much 3 main products that we took a look at. More than close to 60% of this company's total revenue comes from the entertainment, which is their esports and all their digital entertainment platforms. The other 40%, I want to say, comes from their e-commerce stores. And the great thing is there has been a growth year to year in all of this. Very small comes from their financial services. And then they have another portion that comes from other services that they don't really have a true name for. So both these companies have 3 different markets, and both of the 3 markets, I believe, are actually pretty bullish. Where Amazon has North America sales, international sales, and AWS. C has digital entertainment, has e-payment, and has e-commerce. So for me, both of them share similar, even though they might hit different markets in certain aspects, I do believe the revenue is broken down into pretty bullish markets. So for that, I'm actually going to give a point to both Amazon and C. All right, so right now, C is actually winning. It's 2-1 versus the behemoth Amazon. And next, we're going to take a look at future growth. And here, I'm going to take a look at expectation growth for both these companies and see which one is expected to grow at a faster rate. All right, so next, let's take a look at future growth, and let's start off with Amazon. Amazon, on average, is expected to grow revenue about 14.8% a year for the next 3 to 5 years. This is actually less than the industry. The industry is expected to grow 16.5%, and the market is expected to grow 9.4%. So Amazon is expected to grow revenue faster than the market, but less than the industry on an annual basis for the next 3 to 5 years. Next, let's take a look at earnings growth. So earnings growth for Amazon is expected to be 38.4% a year for the next 3 to 5 years. Remember, this is just an average number based on expectations of analysts. The industry is expected to be 33.9 and the market is expected to be 22.9. So this is actually pretty strong earnings growth and very decent revenue growth for Amazon. Revenue is beating the market, but it's not beating the industry. Earnings is beating both the industry and market growth. Now let's take a look at C Limited. And C Limited here, we can see it is expected to be the revenue growth both in the industry and the market. So revenue growth for C is expected to be 28.6% for the next, on average per year for the next 3 to 5 years, where the industry is expected to be 13.9 and the market is expected to be 9.4. Now, if we take a look at earnings, earnings is expected to grow at 64.9% when the industry is expected to grow 37.6% and the market is expected to grow 22.9%. So it is expected to grow even faster than Amazon as well, right? Forecasted annual revenue growth for C is 28.6%, where Amazon is 14.8%. Revenue earnings growth for C is 65%, where for Amazon is 38.4%. So here I'm actually going to have to give another point to C. All right, so right now that's 3 points for C and 1 for Amazon, but we still have a lot of things. And I do believe the ones we're going to come up with later, Amazon might have a better chance when we take a look at margins, cash flow margins, balance sheets, and at least valuation as well. I do believe Amazon might have something there. So now let's take a look at revenue growth. And revenue growth here, I'm going to take a look at the past 3 years of revenue and see who is growing at a faster rate historically, right? We already saw futuristic based on expectations, but now let's take a look at actual numbers in the past. So here I'm going to end up using this amazing system that I use for all my fundamental analysis, and that's Lazy FA. So let's start off here with Amazon. Amazon 2019 grew 20% revenue year over year. On 2018, it grew 30% year over year. And on 2017, it also grew 30% year over year. So I want to say on average for the past 3 years, it has grown a little bit over 25%. Now let's take a look at C. So C in 2019 grew 163%. And we already know based on this number, we can see who's going to go the point for. But if we take a look at 2018, it grew 99% year over year, and 2017 grew 20% year over year. So if we put this average together, it's way above Amazon. So here, C is gonna have another point, and I'm pretty sure these Amazon guys on this, watching this video, have either left right now or are probably about to curse me out. But let's not, there's still so many points out there that Amazon still has the potential to turn this around. And if you guys actually, I mean, remember, this is just based on my thoughts on the points. You guys maybe let me know in the comments, where would you have given any point differently anywhere here. So now let's take a look at margin growth. So let's start off with Amazon. So Amazon here, the first thing I'm seeing is their gross margins. Gross margins continues to go up, right? In 2019, it was 41%, where in 2017, it was 37.1%. So that's a good thing. Profit margins, Amazon is profitable with profit margins of 4.1%. And if we take a look from 2017, that was actually 1.7%. So we're seeing a growth in both gross margins, and we're seeing a growth in both profit margins as well. And now let's take a look at C. So C's profit margins are currently non-existent. This business has not been profitable in the past 5 years. And even though if we take a look at just the past 3 years, which is what we did on Amazon, their profit margins do seem to be improving over time. But their gross margins are all over the place. And obviously here we are gonna have to give a point to Amazon, and Amazon is kicking back some life. So Amazon right now with 2 points and C with 4 points. But remember, even though C has more points right now, it doesn't mean that Amazon is a bad investment, right? Amazon is a giant. Their market cap growth was almost similar to SE. Their future growth, even though it was nowhere near the expectation of SE, For a $1.5 trillion market cap company that is still growing at over 20%, that to me is very, very impressive. All right, so next let's take a look at cash flow margins. In cash flow margins, I'm taking a look at pretty much the operating cash flow margins to see, hey, is this company making money from its everyday activities? If we take a look at Amazon, the first thing I know is I notice is yes, they are positive in operating cash flow margins. They made 13.7% in their most recent year. And if we take a look from the past 4 or 5 years, it does seem like there is an uptrend in operating cash flow. Now, let's take a look at operating cash flow for C. So the first thing I'm seeing though is it's pretty all over the place. And that's again, Amazon is showing to be a company that's more reliable, but remember, Amazon, it's already at later stages of its life. So that's kind of expected to be. So operating cash flow margins for the most recent year of C was positive 3.2%, but almost every year before that was on the negative side. So to me, obviously, I'm going to have to give another point to Amazon. But one thing that I am liking about C is first, look, as revenue is increasing, and this is my revenue line, the net cash flow from operations is kind of following that similar trend. So if that revenue in theory continues to grow, we will see growth in net cash flow from operations. And this is usually the power that you see with growth stocks is the more money they're making, they're finally going to start making a lot more money. And with this strong revenue growth for the next 3 to 5 years, it's just strong the potential that this business has. So here, let me just show you guys what I was talking about. Net cash flow from operations for Amazon. As their revenue increases, you're seeing an uptick as well in their net cash flow from operations. So here, let's give that point to Amazon. So Amazon is not out of the race now. It's 3 to 4 right now on Amazon versus SE. So when I take a look at the balance sheet, we obviously know that Amazon will probably have a lot more money than C. So that wouldn't be a fair comparison. The best way to do is actually do a ratio between the two, right? So we're going to take a look at what I consider quick cash, which is going to be current investments in cash, and compare it to total debt. And that would give us a ratio value instead of actual numerical values, because a true numerical value I don't think would be fair, especially with Amazon being a $1.5 trillion market cap, where C is barely $60 billion in market cap. All right, so first let's start off with Amazon. So Amazon has no current debt, which is something I would have expected, right? This is a business that they pretty much probably have just long-term debt to finance their stuff, and they have non-current debt of about $63 billion. And right now, with rates the way they are, it's probably pretty cheap. The business, they have about $36 billion in cash and about $20 billion in current investments, so very close to $60 billion in quick cash. So to me, that would give me a total ratio of 1-to-1 in cash versus total debt. Now, if we take a look at SE, SE's has about $1.5 billion in non-current debt and $87 million in current debt. So close to $1.51 billion of total debt, where they have about $3.5 billion in quick cash. So in theory, this is more of a little bit like 2.2, 2.3 ratio. They have way more cash than they do have current debt and non-current debt. So to me here, I do like C's balance sheet a lot better, and I am gonna give the balance sheet point to C here, and this is gonna probably give them a pretty big lead now. So C is now at 5 points and Amazon is at 3 points. But again, right now we're just taking a look at numerical values, but we also got to remember that they're actually in different stages, right? Where Amazon is more, they're already making profits, right? They're already making money. So when you're making money, you don't have to really worry too much about having that strong cash to debt ratio, because if you have a strong income, then you'll be able to pay off that debt. Unlike C. So C, on the other hand, is not profitable at the moment. So they need to have a lot of cash right now because they need to be able to survive at the time when they're not making money. So for that reason, they need to have a better cash and cash equivalents. Pretty much they need to have more cash than debt, right? For example, think about yourself. If you have no job, you would rather have a lot more cash than debt before you ever quit your job, right? Because you would have no source of income. But now if you did have a job, it would be different, right? You wouldn't mind having some debt and a little bit less cash and putting that cash to work somewhere else because you know you have some form of income coming in. And actually, after having this thought, I think both of them deserve a point here. So I'm actually gonna give a point both to Amzn and SE here based on their balance sheets. They're both on different stages in their life, and I do believe both of them have a very, very strong balance sheet. So what's that right now? That's Amzn at 4 and that's C at 5. And we only have 2 more points left over. So next, let's take a look at valuation. So valuation, I do the following. I take a look at the forward PE ratio and forward price to sales ratio and see which one is looking cheaper. So if we take a look at forward PE ratio, we know that Amzn is the only one making money right now, and Amzn is expected to have a forward PE ratio of 79.9 2 years from now by December 2021. In December 2021, C is still not expected to make money, so it does not have a forward PE ratio. Now, if we take a look at forward price to sales ratio, forward price to sales ratio for Amzn is 3.7, where C is actually 8.74. So Amzn is a lot cheaper than C at the moment. So here we are going to have to give that point to Amzn here. So right now we actually have a tiebreaker. And this is where I probably get all the hate mail. So now these are going to be my thoughts. So my thoughts here is, which one do I expect to grow better or to grow at a higher rate? Which one do I believe will give me a better bang for my buck now? So let's say I had, like, for example, $100,000 to invest in one of these. Which one would it be? And I do believe both of them will give me positive returns in the long term of things. Now, and that's the thing, right? I do believe both of them can actually give me a positive return in the long term of things. But if both of them can give me a positive return in the long term of things, which one do I believe will give me higher returns? And let's take a look at Amzn first. What do we know about Amzn? Amazon's already 1.5 trillion market cap, but that market cap is not going to stop me from investing, right? I do believe tech, even though it is one of the biggest companies, it still can continue to grow and grow. It's growing revenues at over 20%, right? That is insane for a company this big. They are in AWS. They are the #1 leaders in the clouding market, which is a market I am completely bullish on. And they only own 33% of the total market, and it's only 13% of their total revenue, but they still make a lot of cash out of it. The other things, Amzn has a lot of cool things. Amzn, their e-commerce stores, they have Twitch, which is the leading streaming platform of esports in the world right now, and there's no competition to it. So Amzn has these pretty cool things, but then we have C. C is a strong grower, right? This one is growing at a high pace of over 60% a year, and that's impressive. It is in 3 markets that I'm completely bullish on: e-commerce, e-payments, and esports gaming. They are also, even though they are not profitable right now, I do believe as they continue to go up, they will reach that profitability. And with the 50 billion market cap, even if they grow to 500 billion market cap, which they'll still be 3 times smaller than Amazon, they will still give you 10 times return, where I don't really see how Amazon can go to a $15 trillion company in the next 5 to 10 years, where C can actually expand this market in Southeast Asia. And this is where we have, for example, India, one of the most populated countries in the world. So for me, I do believe if I'm a true growth investor, I would pick C over Amazon. That's because that's if I was a true growth investor. But now if I was a growth investor but also want some stability in it and some form of backing to it, I do believe Amazon would be the thing. But I want to consider myself more of a true growth investor than that. So I am going to have to give the point to SE. And here it's actually game over. So SE has 6 points, where Amazon has 5 points. And remember, this does not mean that I consider Amazon a bad investment. That's not what the point of this video is. It's to pretty much just bring up two great companies, compare them against each other, and just really see how they go head and head against each other, and see why I enjoy them. And it's just this mind processes game. When I invest in companies, I want to take a look at everything around me. So I hope you guys enjoyed today's episode. Like always, make sure to hit the thumbs up, make sure to hit the bell, and let me know, what did you guys think about this episode?